On January 3, 2026, Washington didn't just remove a man from a palace, it grabbed a lever on the energy system. According to Reuters, U.S. forces captured Nicolas Maduro and the shockwave rippled through Venezuela's oil flows, exports stalled, storage filled, and the country's barrels became hostage to U.S. sanctions, licenses, and enforcement power. Now zoom out to the real target of this story, Taiwan. Beijing has spent decades calling Taiwan a reunification mission, and it has spent the last few years rehearsing the coercion that could precede an invasion. But wars are not won by slogans or missiles alone. They are sustained by fuel, shipping, insurance, payments, and the ability to keep factories running while the world tries to cut you off. Beijing knows this, which is why it has pushed alternatives, expanding CIPS, buying gold, and talking up but SWIFT. Data still show the renminbi remains a minor share of global payments, exactly the vulnerability sanctions exploit. That is why Venezuela mattered to China. China is the world's largest crude importer. According to the U.S. Energy Information Administration, it imported roughly 11.1 million barrels per day in 2024. And according to Reuters, hundreds of thousands of barrels per day have been arriving from Venezuela oil that moved through convenient channels. If the United States can choke that channel at will, China's Taiwan timetable gets more expensive, more fragile, and far more dangerous for markets. For Beijing, Taiwan is not a distant foreign policy file, it is a core legitimacy project wrapped in history, identity, and regime survival. The Chinese Communist Party frames the island as unfinished statehood, and China's 2005 anti-secession law explicitly authorizes non-peaceful means if, in Beijing's judgment, secessionist conditions are met. Over the last few years, that political claim has been paired with a military tempo designed to normalize pressure. Large-scale drills, air and naval activity around the island, and messaging meant to convince Taiwan and the world that resistance is futile and timing is China has to choose. But there is a less visible battlefield that decides whether an invasion is feasible beyond the first week's energy and finance. Modern great power war is a contest of supply chains, tanker routes, insurance markets, spare parts and payments plumbing. Beijing's planners understand that the United States and its allies would respond not only with weapon support to Taiwan but with sanctions, export controls and pressure on shipping and banking, exactly the levers that can starve an economy of fuel and liquidity. That is why China has tried to build insulation, expanding its cross-border interbank payment system, and increasing official gold reserves as a hedge against financial coercion. Yet, according to SWIFT data, the renminbi still represents only a small fraction of global payment messages, meaning the dollar-centric system remains the terrain where the West can impose the fastest pain. This is where Venezuela enters the Taiwan equation. According to Reuters, U.S. forces captured Nicolas Maduro on January 3, 2026, and Venezuela's export flows were disrupted under the gravitational pull of U.S. enforcement, sanctions, and licensing power. In a Taiwan crisis, that shift turns a politically compatible oil supplier into a constrained asset, potentially controlled, conditioned, or denied. If you want more reporting that connects the hidden machinery of oil, money, and war, hit like, subscribe, and turn on notifications. Your support makes it possible to keep producing deep dive videos like this one. And for transparency, every data source cited in this video is listed in the description. To understand why Venezuela suddenly sits inside the Taiwan equation, you have to start with a blunt premise. Beijing is not just preparing ships and missiles. It is preparing to survive the economic and financial counterpunch that would come the moment it tries to seize Taiwan. The Chinese leadership has watched carefully how the West weaponizes money, messaging networks, and insurance markets. In 2022, Europe moved to ban certain Russian banks from the SWIFT system, and SWIFT confirmed it disconnected designated entities pursuant to EU regulations. In parallel, roughly 210 billion euros in Russian central bank assets were immobilized in the EU, according to a European Parliament briefing. And US congressional research has described the scale of Russia's frozen reserves as about $300 billion. The lesson for Beijing is simple. In a high-end confrontation, the first shots may be financial, and the battlefield is global. That is why de-dollarization is not just propaganda, it is risk management. China has pushed to internationalize the renminbi and reduce dependence on Western-controlled payment rails. One pillar is CIPS, China's cross-border interbank payment system. According to an analysis of published CIPS figures, annual value processed through CIPS rose to about 175.49 trillion yuan in 2024, with roughly 8.2 million transactions. A sharp year-on-year jump. Those numbers matter because they signal capacity building. More pipes, more volume, more redundancy. But they also underline the limit. Scaling a system is not the same as replacing a global standard under wartime pressure. The hard constraint shows up in SWIFT's own reporting. According to SWIFT's RMB tracker, the renminbi's share of global payments by value was about 2.88% in June 2025, keeping it in sixth place, meaning the overwhelming majority of global payment traffic still runs through currencies and correspondent networks the West can influence. And in SWIFT's reporting on international payments excluding the Eurozone, the RMB share was about 2.34% in September 2025, still small in the context of a sanctions shock. In practical terms, that means a Taiwan crisis would collide with a financial reality. Trade finance, insurance, and bank compliance teams default to the dollar system because that is where liquidity is deepest and legal risk is most enforceable. Beijing has also built a second layer of insulation: gold. Gold is not a payment network, but it is an asset that does not carry counterparty risk in the same way as foreign bonds or bank deposits. Then comes the most important layer for a Taiwan scenario. Oil armies run on fuel, economies run on diesel, and sanctions run on choke points. China is structurally exposed because it imports the bulk of its crude, according to the U.S. Energy Information Administration. China received about 11.1 million barrels per day of crude oil imports in 2024, making it the world's largest crude importer. Colombia's Center on Global Energy Policy puts that dependence in stark terms. In 2024, crude imports of 11.1 million barrels per day represented about 74% of China's apparent oil consumption. That is not a statistic, it is a vulnerability, so Beijing stockpiles. According to Reuters, trade sources said China aims to expand its stockpile to cover as much as 6 months of imports, roughly 2 billion barrels, an ambition that signals how seriously it takes blockade and sanctions risk. And Colombia's analysis estimates that combined strategic and commercial stocks provide at least 96 days of crude import coverage at 2024 import levels. Reuters has also reported that China's inventory behavior has become so influential that it can effectively put a floor and ceiling under prices by adjusting storage rates, with estimates suggesting between 1 and 1.4 billion barrels in storage and additional capacity being built. In other words, China is trying to buy time because time is what you need when the world is trying to cut off your fuel. This is where the historical parallels become financial and immediate. Iran learned in 2012 what it means to be isolated from SWIFT. Reuters described the move to cut off sanctioned Iranian banks as shutting down a major avenue for business with the world. Russia learned in 2022 what it means to watch sovereign reserves become politically unusable. Beijing is trying to preempt that fate because if it moves on Taiwan, it is effectively volunteering for the harshest version of economic warfare the modern system can deliver. What made Venezuela strategically valuable to Beijing was never just the number of barrels. It was the combination of barrels, politics, and sanctions geometry, the kind of geometry that matters only when the world is dividing into hostile blocks. For years, Caracas offered China something rare: heavy crude that could be quietly routed to independent refiners, and a government structurally hostile to Washington, meaning it had fewer political inhibitions about deepening ties with America's main rival. That is why the relationship grew into something closer to strategic entanglement than normal trade. The entanglement is measurable. According to Reuters, China has remained both a key customer and an investor in Venezuela's oil sector, with Chinese firms investing roughly $2.1 billion in the oil industry since 2016 and Venezuelan debt to China still over $10 billion, with some deliveries structured as repayment barrels. A data's project-level documentation around China Development Bank facilities tied to Venezuela shows how the financing architecture functioned. Large tranches, rollover mechanisms, and repayments linked to the oil for loans model that effectively turned crude into collateral. And according to the Associated Press, Venezuela owes China an estimated $10 billion under oil for loan deals, and China's stakes include claims connected to billions of barrels in infrastructure investments that become politically exposed when power shifts in Caracas. Now put that next to the operational reality of the oil flows. Venezuela's output collapsed over the past 2 decades, and Reuters notes production around 1.1 million barrels per day in 2025, down from roughly 3.5 million barrels per day in the late 1990s, making every incremental heavy barrel more valuable to buyers who want refinery-compatible crude at a discount. In that context, even a small supplier matters when you're trying to diversify wartime risk. According to Reuters, Chinese imports of Venezuelan crude averaged about 389,000 barrels per day in 2025, around 4% of China's seaborne imports, and shipments to Asia stopped at the beginning of 2026 after U.S. action disrupted the channel. Reuters also reported imports reaching roughly 470,000 barrels per day in 2025, with much of it going to independent Chinese teapot refiners and some volumes moving as rebranded shipments. Then came the regime shift in enforcement power. According to Reuters and the Associated Press, U.S. forces captured Nicolas Maduro in early January 2026, after which Venezuela's interim leadership began exploratory steps toward renewed diplomatic engagement under the shadow of U.S. sanctions and waivers. The market implication is not subtle. Access to Venezuelan crude becomes conditional on Washington's licensing decisions, compliance rules, and maritime enforcement. Reuters reporting on India's reliance underscores the new reality. Companies are negotiating directly with U.S. State and Treasury for authorization to import Venezuelan crude, and Reliance previously received roughly 63,000 barrels per day through early 2025 under U.S. licenses. In other words, Venezuelan oil is no longer just a commodity, it is a permissions regime. This is the strategic squeeze on Beijing in a Taiwan scenario. China is the world's largest crude importer. The U.S. Energy Information Administration reports China received about 11.1 million barrels per day of crude imports in 2024 in a Taiwan invasion. The West's fastest tools are not amphibious landings, they are sanctions, export controls, shipping insurance pressure, and secondary sanctions that force buyers and carriers to choose between U.S. market access and forbidden barrels. Venezuela had offered Beijing a politically aligned counterparty that could tolerate reputational and legal risk. Once Washington can gatekeep that flow, Beijing's margin for error narrows. Yes, China can substitute. Reuters reports traders expect Chinese independence to replace Venezuelan barrels with Iranian and Russian heavy crude, with Iranian heavy offered at steep discounts. But substitution is not costless, it concentrates dependence on the very sanctioned networks most vulnerable to interdiction, insurance withdrawal, and financial choke points. And that loops back to Beijing's de-dollarization problem. When a supply chain is mediated by U.S. licensing and compliant settlement and documentation tend to migrate back toward dollar-linked channels and Western-readable paper trails, exactly the opposite of what Beijing has been trying to build. This is why the Venezuela shock matters to markets watching Taiwan. It is not that China runs out of oil tomorrow. It is that, in a crisis, the U.S. gains one more lever to raise China's war costs by tightening fuel optionality and forcing crude procurement into narrower, riskier, more sanction-exposed corridors. When a conflict's feasibility depends on sustaining operations for months, levers like that do not merely inconvenience Beijing, they change the calculus. The uncomfortable conclusion is that the Taiwan question is not only a military timetable, it is an energy and finance stress test. China can rehearse blockades and amphibious operations, but it cannot rehearse a full-spectrum sanctions shock without paying the price in real time. The West has already demonstrated that it can immobilize sovereign wealth at scale. A European Parliament briefing notes roughly 210 billion euros in Russian central bank assets immobilized inside the EU. That precedent matters because Beijing's planners understand that. In a Taiwan crisis, the first decisive moves may happen in banking compliance departments and insurance markets, not on a beach. Energy is the second hard wall. According to the U.S. Energy Information Administration, China imported about 11.1 million barrels per day of crude in 2024. That level of dependence turned shipping lanes, freight rates, and allowed suppliers into strategic terrain. And this is where Venezuela becomes a multiplier. According to Reuters, U.S. action in early January 2026 disrupted Venezuelan export flows to Asia after the capture of Nicolas Maduro, effectively placing the two-channel under the gravity of U.S. sanctions enforcement and licensing power. If Beijing moves on Taiwan, Washington would not need to win every battle at sea to impose pain. It could tighten permissions, pressure carriers, and narrow China's options to more sanction-exposed barrels. The third wall is payments. China's de-dollarization narrative is real, but the system is still dollar-centric. According to SWIFT's RMB tracker, the renminbi accounted for about 2.88% of global payments by value in June 2025. In a crisis, that small footprint limits how much trade can be rerouted without touching Western-controlled nodes. So the warning for investors is straightforward. The Venezuela shock is not Latin American news. It is an incremental hardening of the sanctions architecture around the Taiwan scenario, an architecture that can reprice oil, currencies, and risk premiums faster than most portfolios can adjust. So here's the question. If oil access and payment rails can be tightened overnight, what is the real first shot of a Taiwan war? The missile launch, or the moment the world's insurers and banks quietly say no? If you want more analysis that connects geopolitics to market mechanics, like this video, subscribe, and turn on notifications, because the next disruption rarely announces itself in advance.